Gold prices have crashed. Gold prices have crashed. Since 2011, gold has plummeted more than 25%, and the worst may not yet be over. The Profit Strategy newsletter at ETFguide.com warned its subscribers the gold bubble would pop, and it has. Our gold alert given to subscribers in early 2013 resulted in a 500% gain. What happens next in the gold market will shock the entire globe. Join today at ETFguide.com and get a $50 bonus by using promo code SAVE50.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
Welcome to this 2014 special edition of the Index Investing Show. Coming up on today's program, I want to cover the subject of tail risk. No, it has nothing to do with the tail on your pet cat or pet dog, that overactive thing that moves back and forth. Tail risk is all about our expectations in the price movement of assets. Things like stocks and bonds and real estate, that's what we mean by assets. And more specifically, how we always need to be ready for big unexpected moves in the price of these assets. Salil Mehta, he's an adjunct professor at Georgetown University, will be joining me to talk about tail risk. Also coming up, 2 investment themes or trends for the new year, one surprising theme and one not so surprising theme. Stay tuned for that. So we all know that 2013 was a great year for U.S. stocks. We take a look at the total U.S. stock market, which gained around 30%. And some of the ETFs that track that, the Vanguard Total U.S. Stock Market ETF, VTI, is the ticker symbol, rising by that much. And as a testament to the broad strength that occurred in stocks in 2013, if we examine the 9 industry sectors within the S&P 500, each one of those sectors posted positive gains, and most were double-digit gains. Now, as wonderful as that is, we can't deny the role that the Federal Reserve's quantitative easing, or QE, and the role that that has had, or impact that that has had on rising stock prices. So I want to examine this particular stock market, a bull market, relative to previous bull markets. And I did this exercise in the just published January 2014 edition of my Profit Strategy newsletter at ETF Guide. And I wanted to really just look at the relationships between this bull market in terms of duration or length relative to previous bull markets. And a basic understanding of history teaches us that bull markets and stocks can vary greatly in both length of time and price return. And if we take a look at the 20 cyclical bull markets since World War II, we'll see that a bull market is generally defined as an extended period of above average stock price increases coupled with very brief declines, very shallow declines. For perspective, so let's compare the length of this current bull market with previous ones. Now, although the bull run, which began in March of 2009, and the one that began there specifically on March 31st of 2009 to April 30th of 2011, that period of time was 760 days. Now, if we merge that with the October 31st, 2011 to December 20th, 2013 bull market, and those are the dates that I have, the combined duration is 1,541 days. So that's more than double the length of the median bull market since 1945. And by the way, that duration or length of the median bull market since 1945 is just 700 days. On the other hand, the duration of the current bull market cycle is still shorter. It's 1,541 days compared to the 2,830 days that occurred from 1990 to 1998. And it's still shorter than that 1,826 days that lasted from 2002 to 2007. In terms of relativity, in terms of duration, this is definitely not the longest bull market in history, although it is still, by historical standards, overextended. So this is not a statistically unusual bull market that we're currently in terms of duration or length. What is unusual, what is different this time, is its heavy dependence on central bank generosity, unlike previous eras. And so I think that this is the biggest difference between this current bull market and previous ones. More importantly, the bigger question is, how will the stock market behave in a post-QE world? And that is something we'll just have to wait to find out. If you want to read more about the overextended bull, go to etfguide.com and click on the Profit Strategy newsletter. And the January edition covers this bull market from 1945 to present. If you're just joining us, you're listening to the Index Investing Show. Pleased to have you with us. This is our 2014 special edition. And coming up on today's broadcast, I want to cover the subject of tail risk and what that means and why it matters and how to prepare for it. Salil Mehta, he's an adjunct professor at Georgetown University. He'll be joining me to talk about tail risk. What about stock market valuations? We always hear Guru A saying that stocks are expensive, while at the same time, and perhaps in the same conversation, Guru B claiming stocks are cheap. So two gurus saying the exact opposite of each other. One saying stocks are expensive, the other saying stocks are cheap. Who's right? What about now? Do stock market valuations really matter? Well, I'm displeased to say that there is no light bulb in the stock market's brain that suddenly triggers a rally because stocks are cheap. Likewise, that same light bulb in the stock market's brain that suddenly triggers a sell-off because stocks are expensive does not exist. So history, for those of us who still bother with it, it teaches us that the stock market doesn't necessarily need to be grossly overvalued before it can suffer a severe correction. Have we already forgotten what occurred in 2007? If we take a look at the S&P 500's price-earnings ratio, also known as the PE, in October of 2007, the S&P's PE ratio was just 19.42. Now, if we compare that to the frothy levels of March 2000, we see that the PE ratio for the S&P in March of 2000 was 29.41. So by historical standards, what we saw is that the U.S. stock market in the fall of 2007 was an absolute bargain compared to the stock market of 2000. But if we look at history, we also know that that bargain, that sale, that cheapness in stocks still did not prevent the stock market from declining almost 50% over the next 18 months. So in retrospect, what do we learn? We learn that people who used historically cheap PE ratios in 2007 as a rationale or a reason to buy stocks, they were badly misguided. They were badly misinformed. So now the question becomes, will the future be any different for people who use the same rationale as their guide? Oh, stocks are cheap. Stocks are inexpensive by historical standards. Well, that may be true, but at the same time, stock market valuations, we know they matter, but just as important are the emotion and the psychology of the market. And that's what technicians sometimes refer to as market sentiment. We know that emotion and psychology play key roles in moving stock prices. So it's not just about valuations, and this will always be the case. The importance of emotion and psychology in financial markets, so long as the stock market has human participants. So the lesson for us is it's never a good idea to exclusively focus on using one indicator like stock market valuations for a basis of investing or not investing. This is the Index Investing Show. You're listening to our 2014 special edition. More when I return. I'll be right back.
The Index Investing Show with DeLegge.
All right, you're listening to this 2014 special edition of the Index Investing Show. Great to have you with us. I'm your host, Ron DeLegge. I'm also the editor and publisher of ETF Guide and our Profit Strategy newsletter, which is published monthly. We just released the January edition. Pick up a copy at ETF Guide. And when you do, use promo code TRADEUP. You'll get a $50 discount. We're talking on today's program about a couple of things. Number one, the subject of tail risk and what that means for the investments inside your investment portfolio. Coming up in a little bit, Salil Mehta will be joining us. He's an adjunct professor at Georgetown University, and we'll be talking about the meaning of tail risk. We also covered in the first segment a couple of things that had occurred in 2013. Of course, it was a great year for U.S. stocks. But we also talked about the importance of psychology and sentiment, emotion in financial markets. And this will always be the case so long as the stock market has human participants. Yes, metrics matter. Yes, valuations matter, but not exclusively. So that's why we never use stock market valuations or PE ratios or dividend yields or other statistics as an indicator or as a standalone reason to invest or not to invest. The better technique is to use market valuations in conjunction with other key fundamental and technical indicators for a more complete view. And that will not completely eliminate wrong decision making, but it can help reduce making major mistakes in the investment choices that you make. Now, I want to talk about two investment themes or trends for the new year. Now, one is a surprising theme, and one is not so surprising. So let's begin with the one that's not so surprising. And this is something I've talked about on the show for quite some time, and that is the trend of higher yields. Higher yields or higher interest rates, and the bull market that we've seen, the 30-year bull market in bonds, finally seems to be breaking. Now, we've seen this despite the fact that the Federal Reserve has continued relentlessly to buy up long-term U.S. Treasuries. Now, in December, they did announce they would be scaling back their monthly purchases of long-term U.S. Treasuries by around $10 billion. That's not much of a reduction. So the Fed is still making massive injections, massive purchases, multi-billion-dollar purchases of long-term U.S. Treasuries. Now, they've done this despite the fact that interest rates have gone in the opposite direction of which they desire. The Fed obviously wants interest rates. They want bond yields to stay low. But even though the Fed's quantitative easing has continued relentlessly since late 2008, it hasn't necessarily worked out that way. I mean, we've got 10-year U.S. Treasury yields have climbed more than 60% over the past year. So this is a not very surprising trend that I think will continue into the new year, and especially will begin to take hold with the Fed now scaling back its purchases of long-term U.S. Treasuries. What will that mean for bond prices? Well, bond prices are likely to be hurt by that. And of course, lower bond prices mean higher yields because, well, bond prices and bond yields have an inverse relationship. That's right. When bond yields go up, as they have been, bond prices go down. And so this is what has been happening over the past year, and I think it's something that will continue into 2014 It's a firmly rooted trend, a pesky trend that started over a year ago. So what is the way to play this? Well, there's really two strategies to play this particular theme of higher yields and lower bond prices. One way is to shorten up the duration of the bonds that you own in your portfolio. So if you own corporate bonds, municipal bonds, if you own treasury bonds, or even mutual funds that hold these types of bond investments, you want to make sure that you own the funds and the bonds that are shorter in terms of duration versus longer. So what do I mean by shorter? I'm talking about bonds with maturities of less than 10 years. And you will see less of a negative impact on these types of bonds, their prices, when interest rates rise. Now that's one strategy for minimizing the financial damage of higher yields. Another strategy is to trade with the trend, and that is to be short long-term U.S. Treasury bonds. And the way that you can do this is a couple of ETFs that are built for investors or traders that want to capitalize on this theme. You've got the ProShares Ultra Short 20-year Treasury Bond ETF, ticker symbol TBT. You've got the Direction Shares Bear Long-Term U.S. Treasury ETF, ticker symbol TMV. Now, both of these ETFs are designed to increase in value when bond prices, Treasury bond prices, fall. And TBT uses double daily opposite performance to long-term U.S. Treasuries, whereas TMV does the same thing but with triple daily opposite performance. And both of those ETFs, these are bear Treasury ETFs, have been outstanding performers over the past year, TBT and TMV. And again, if this firmly rooted trend of rising interest rates and lower bond prices continues, you will see more upside in these types of ETFs. If you're just joining us, you're listening to the Index Investing Show. Great to have you with us. You're listening to our 2014 special edition. Coming up on today's program, we're going to be talking about tail risk. No, it has nothing to do with your pet cat or your pet dog's overactive tail. It's all about our expectations in the market price of assets, things like stocks, bonds, real estate, gold. So Salil Mehta, he's an adjunct professor at Georgetown University. He'll be joining us in the next segment to talk all about that. You can pick up our free podcast if you ever miss our regular radio broadcast. It's available at iTunes. Just search under the Index Investing Show. You can also pick up our podcast at YouTube. Again, just search under the Index Investing Show. You can follow us on Twitter at Index Show, and you can read my daily articles at etfguide.com. So the next investment theme or trend that we're going to talk about is a surprising theme, one that I think is shocking. So we're going to get into that in the next segment. I also want to talk about a few trading tips that I think are an excellent reminder for not just traders, but investors. So I've organized this as what I call my 10 commandments for trading ETFs. So I want to get into that. Also, if you had not had a chance to check out my monthly newsletter, it's available at etfguide.com. We've just issued the January edition of the ETF Profit Strategy newsletter. The lead article talks about Hallelujah, I'm a Bum, as a salute, as a kick in the pants to Fed Chairman Ben Bernanke. You'll enjoy that along with much more. Top yielding ETFs, a global look at the ETF marketplace, also a look at not just the high yielding ETFs, but some of the top performing sector funds, along with the market breakdown of what the next big moves are and how to position your money to capitalize on them. You're listening to the Index Investing Show. I'm Ron DeLegge. Coming up next, Salil Mehta with Georgetown University. I'll be right back.
The Index Investing Show with DeLegge.
Have you met Jane Investor? She wants her investments to grow, but she's too busy to bother. In fact, Jane Investor is so busy she didn't realize owning real estate investments in the wrong brokerage account exposed her to unnecessary taxes. She also forgot to roll over her 401k plan because, well, she was too busy. The Profit Strategy newsletter at etfguide.com helps busy people like Jane Investor to stay on top of their investment portfolios. We tell you what to buy, what to sell, and when to do it. It's okay to be busy, but it's not okay to be sloppy with your investments. The Profit Strategy newsletter at etfguide.com will save you time and help you to succeed. Join today and get a $50 bonus by using promo code JANE50. Our monthly newsletter, our weekly picks, and our technical forecast will keep you ahead of the pack. Go to etfguide.com to get started and promise yourself to never ever be too busy to be properly invested. Have you met Jane Investor? She wants her investments to grow, but she's too busy to bother. In fact, Jane Investor is so busy she didn't realize owning real estate investments in the wrong brokerage account exposed her to unnecessary taxes. She also forgot to roll over her 401k plan because, well, she was too busy. The Profit Strategy newsletter at etfguide.com helps busy people like Jane Investor to stay on top of their investment portfolios. We tell you what to buy, what to sell, and when to do it. It's okay to be busy, but it's not okay to be sloppy with your investments. The Profit Strategy newsletter at etfguide.com will save you time and help you to succeed. Join today and get a $50 bonus by using promo code JANE50. Our monthly newsletter, our weekly picks, and our technical forecast will keep you ahead of the pack. Go to etfguide.com to get started and promise yourself to never ever be too busy to be properly invested.
How do you measure financial risk, and how can you incorporate smart risk planning in your own investment portfolio? Here to talk with us about that is Salil Mehta. He's a statistician. He's a former department director at TARP and now an adjunct professor at Georgetown University. Salil, welcome to the Index Investing Show. Great to have you with us.
Likewise. Thanks for having me, Ron.
Let's begin about talking and discussing the subject of tail risk. What is tail risk?
Tail risk is having a downward move in an asset price that is greater than what people normally expect and more often than people generally expect.
So would that be like a black swan, or is that not correct?
It's a little bit different. So I think a good example is if investors look to have maybe the S&P 500 in a sort of ETF format or something along those lines. It's a broad market, and they may assume that maybe once a month you might see a downward move in the entire stock index. Once a month, that could be in the magnitude of around 2%. But in reality, you might have once a month a downward move of more like 3%, or at the 2% level, maybe that would happen twice a month instead of once a month. So that's really what tail risk is. It's more systematic, and black swan events are a little bit different in the sense that they're exogenous. They come out of left field. For example, a 9/11 attack, or something that might happen in Syria that can kind of change things. Very exogenous to what's really kind of inside, the way people should think about their assets, general performance risk.
Now, what about tail risk, Salil, as it applies to, let's say, other asset classes and the performance impact there? You just kind of gave us a heads up on stocks. Give us a heads up on tail risk and how it impacts other assets.
Sure. Tail risk applies to all asset classes in the financial markets. We've seen tail risk, for example, show up recently in treasury markets, where people generally thought that this is really a risk-free asset class values that generally go up and almost never come down. People thought the same thing about the real estate market through 2007. And so we see this in different asset classes, and really the only asset class, barring a huge financial shock, would be having some money in cash. But all of these financial instruments, they do tend to have some tail risk in there. And in addition, the economic data that we look at, in which we then try to value what asset values should look like, that too has some tail risk. And we see that in massive revisions to GDP data or unemployment data, things like that.
If you're just joining us, you're listening to the Index Investing Show. Pleased to be talking with Salil Mehta. He's a statistician, financial scientist. He's also an adjunct professor at Georgetown University. He's also working on a book about statistics and numbers. Now, what about current events? How does tail risk impact them?
Sure. So in terms of current events, if people are looking at, well, what's happening with the current debt battles happening in Congress, or what's happening with tapering, those would generally not be something that impacts tail risk. Tail risk is really embedded in long historical data sets of financial instruments, be it bonds, stocks of other nations, and things like that. So what we're seeing right now play out wouldn't really impact whether, or even explain whether or not we have more or less tail risk. Tail risk seems to be present regardless of the sorts of geopolitical concerns.
So, thinking about what you just said about tail risk, Salil, and how some investors and traders look and extract historical data, I think about those that trade upon seasonal patterns. Kind of risky after what you just mentioned, tail risk. I mean, tail risk at any given moment can render completely worthless all of those trades and research based upon seasonal or historical seasonal patterns. What do you think about that?
You're definitely right, Ron. There's definitely cross currents when it comes to this sort of analysis. When you talk about seasonal patterns, so it could be days of the week or months of the year, there tends to be seasonal patterns that show, for example, higher degrees of risk in equity markets in October, November time. But that doesn't mean that every October, November, people should be frightened of the market. So there is times where you need to incorporate multiple factors, not just one, like seasonality, something like that. And certainly, people should look at multiple inputs into their analysis. So look at multiple risk measures and look at multiple sets of economic or fundamental data, and not just look at what is just in vogue in the current news.
So we know that tail risk can cause assets to sometimes trade outside of their historical price range. So let's break this down from an investment perspective and the individual investor. How should an investor design their investment portfolios with tail risk in mind?
Sure. So one thing to keep in mind is that they should demand and look at multiple, measures of risk in whatever asset that they're trying to invest in. So instead of just looking at what's the expected return that they might get and get excited about that, look at some of the ways in which the asset class could experience losses. And in that sense, they would probably come up with something that would have a couple different outcomes. The first is that things that have been considered more risk-free, like bonds, treasuries, would generally have more risk than they might anticipate, not as much as equity still, but still higher than risk-free, literally. And then the second is they might want to keep a higher level of cash in their portfolios to take advantage of these extreme moves in the market, which inevitably occur, and they'll be better off having some cash on hand to take advantage of those opportunities.
Isn't that great advice? I mean, cash is, to me, like the Rodney Dangerfield of asset classes. I mean, it gets absolutely no respect, and that's a really, really good point. If you're just joining us, we're pleased to be talking with Salil Mehta. He's an adjunct professor at Georgetown University. He's a statistician. He's a financial scientist, and he's an author. He's got an upcoming book. One final thing before you take off. how important is tail risk versus other types of risks that investors usually consider and try to plan around?
Sure. It depends on where we are in any sort of volatility regime or where we are in the investment climate. So right now, I would say that investors have been very complacent. They've gone through multiple years of having very low volatility, much lower than normal. And this is something where usually normal measures of volatility, like standard deviation, would be fine. But especially now when people have been lulled into a false sense of security, you might want to anticipate that, a year from now, we can have a lot more tail risk, and those sorts of asset classes should be considered more risky than you might normally want to take into account tail risk measures. So we'll definitely revert to the mean, and it won't be, it should be something people should be more cautious of.
Absolutely. Instead of shorting volatility, maybe go long volatility. And especially, you mentioned there, volatility being low, we see the VIX definitely trading near the, I know at least over the past decade, near its 10-year average low or historical range. Well, that was a great interview. And just before you leave, tell us a little bit about your upcoming book. I know you're working on a book about statistics. Tell us more.
Sure. Yeah, sure, Ron. I'm working on a book that discusses topics of statistics. It goes through the basic types of statistics you would learn in current college curriculum, and it applies that to a variety of settings in economics.
Well, we're looking forward to it, and I hope to have you back. We can talk a little bit more about that. Again, you just heard from Salil Mehta, adjunct professor at Georgetown University and statistician and financial scientist. This is the Index Investing Show. I'm Ron DeLegge. More when we return. Go nowhere.
The Index Investing Show with Ron DeLegge.
Welcome to this special edition, 2014 edition of the Index Investing Show. So we know that 2013 was a great year for U.S. stocks. On the other hand, the duration of this particular bull market is getting a little bit long in the tooth. It is definitely an overextended bull. And what I did was I looked at the length of this particular bull market, the duration, and compared it with previous eras. And although it is a long in the tooth bull market, I mean, it's been over 1,500 days, but that's still, by historical standards, it's much shorter than the 1990 to 1998 period, along with the 2002 to 2007 period. So today's bull market duration is definitely long by historical standards. Remember, the median bull market lasts just 700 days. We're already at almost 1,600 days. But the key here is that while today's bull market duration or length may not look statistically unusual, its heavy dependence on central bank generosity is definitely unlike previous bull markets. And I guess that's the biggest difference of now versus then. The question then becomes, with the Federal Reserve now scaling back its QE or quantitative easing, in December they reduced the amount of monthly purchases that they're making in long-term U.S. Treasuries. How will the stock market behave in that type of cycle of scaling back and eventually completely eliminating quantitative easing? So that will be a question that will have to be answered. Now, if you're just joining us, you can follow our program at Twitter, at Index Show is my Twitter handle. You can also email me, ron@indexshow.com, if you ever want to send me a question, a comment about a particular stock, mutual fund, ETF. Also, check out my monthly newsletter at etfguide.com. The January edition is out. So we talked about one investment theme that is a not so surprising theme that I think will continue in 2014, and and that is the theme or trend of rising interest rates, rising bond yields, and lower bond prices. Now I want to share with you one surprising theme, one shocking theme, and I say shocking because I think it is shocking because the expectations are that gold and other precious metals will continue to slide in 2014. It was a brutal year for gold. Gold slid more than 30% and really had its worst performance in decades. But this is a bear market that, as you know, if you've been a listener of this broadcast, I've pointed out to you that didn't begin in 2013. This is something that goes back to mid-2011. That's really when this bear market in gold and other precious metals began. If we take a look at the gold experts and the toxic advice that they've been spewing, I'd like to share some of the things that they said about gold in 2013. This is from Yahoo Daily Ticker. This was on December 6th of 2012. And Peter Schiff said that gold's uptrend is still intact. Peter Schiff again to Market Watch on February 13th of 2013. He said that gold at $5,000 an ounce and beyond, I'm sticking to my call. That was Peter Schiff. That's what he told Market Watch. How about James Turk? In January of 2013, to an outlet called Arabian Money, he actually had the audacity to up his gold forecast from $8,000 an ounce to $11,000. And then how about John Paulson, the hedge fund manager that made his billions during the 2008-2009 credit crisis? Hedgeco in May of 2013 reporting that he lost around $1 billion in busted gold investments. So is it really any surprise to us that the gold experts have been so badly wrong about the direction of gold bullion? I mean, do they ever look at a chart? Now, I've told you multiple times on this very program that the correct place to be in terms of gold in 2013 would be to be short gold and to be short gold miners. And we talked about this multiple times. All you have to do is listen to some of the podcast archives of this very program. Go back and you will see very clearly my position on gold. We talked about ticker symbol DUST, which is the direction gold miner bear 3X shares. That particular ETF was one of the single best performers in 2013, gained over 100%. And we also issued many trade alerts in my weekly picks at etfguide.com, actionable trades related to this theme of collapsing and crashing gold prices. And between the podcast and between my weekly picks and newsletter at ETF Guide, this was a mega investment theme that I nailed, and I'm proud to say that. I also want to give you a shocking update on what I think could be ahead for gold. Now, this is also contained within the January edition of the ETF Profit Strategy newsletter, and it looks at the gold market in terms of sentiment. Now, sentiment extremes, and that's what we have right now in the precious metal market, can point to sharp reversals ahead and even trend changes. For example, overly bearish sentiment can signal an upcoming bounce or a potential trend change, and that could be an opportunity to go long. And with this particular situation with gold, we've got year-end tax loss selling in full force, and hatred for precious metals is almost universal. And in gold, what's happened is it's reached bearish sentiment extremes. And when we look at the history of these bearish sentiment extremes, what you'll see, and this goes back, we've got a chart illustrating this back to 2005, every single point in time when these bearish sentiment extremes have peaked in the gold market, we've seen a sharp reversal. So we've got this same situation right now in the gold market. So this is an opportunity, a short-term opportunity, a short-term trade. We could very well see a sharp reversal in gold prices and precious metal prices in early 2014. Now, I'm not going to declare that it's an official trend change, but a sharp bounce or sharp reversal could be coming. The specific actionable trades are listed in the January edition of the ETF Profit Strategy newsletter. So that is the shocking or surprising investment theme for early 2014. Now, before we end our 2014 special edition of the Index Investing Show, I want to just say one particular thing about my 10 commandments for trading ETFs, and one commandment in particular, that I think needs to be more practiced by the individual investor. And this is the commandment of always using stop-loss orders. This is true whenever you enter a new ETF position or a new stock position. You should always have a safety net that protects you against price declines. And that's what a stop-loss order does. It gets you out of those ETF shares or that particular stock at a price predetermined by you. It's a disciplined way to trade and invest in ETFs, and it helps you to avoid escalating losses. You know, the types of losses that are 20, 30, 40, 50% losses. Those are what we call catastrophic losses, and it's almost impossible to ever recuperate or rebound from that type of catastrophic loss. And that's why a stop-loss order makes total sense. It prevents that sort of thing from happening. That's why it's designed, or that's the purpose of it. The other good rule of thumb is to increase your stop losses, your trailing stop losses, as the price of your securities increase. So this is a very important thing. So remember, when the price of your ETF or your stock increases in value, don't forget to increase the price of your trailing stop-loss order. In this way, you can protect your profits and make sure they don't completely evaporate. And then one other thing, too, if you're using leveraged ETFs, like some of the funds we talked about, ticker symbol DUST or TBT or TMV, generally a bigger stop-loss order is a good rule of thumb, just because there's more movement in these types of ETFs on a daily basis. So a good rule of thumb, 7 to 10% stop loss on the leveraged ETFs. Well, that does it for another episode, our special edition of the Index Investing Show. Great having you with us. @Index Show is my Twitter handle. My email address, ron@indexshow.com. Join us again next week, same time, same station. And until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.